There is something big happening in the world's markets right now. It began back at the end of November, and it continues to grip the world as 2025 begins, even the stock market, if you can believe that. We've seen foreign rates crash and currencies collapse. Markets everywhere have picked up on this abrupt shift and haven't let it go ever since. We do have a couple of suspects to go on. Everything from monetary difficulties to sudden financial risks in places like China, macro deterioration in the U.S. labor market, and even the possibilities that might arise over the return of trade wars. That's one we do have to consider. What we do know is that starting during the week of Thanksgiving, it's as if someone flipped a switch and unleashed chaos onto November. Brazil's real, India's rupee, massive flight to safety in China. Most of all, a reverse in the US dollar swap market. In other words, 2025 begins in the shadow of whatever it was at the end of November 2024. And with last year done, we can now see how those markets treated the major developments that came up in the final months of it. How those were considered leads us to evaluate the November suspects, therefore 2025's prospects. From rate cuts to the Trump trade and, yes, the possibilities of a trade war, we've all had enough time since they've happened to digest what's happened to start drawing some major conclusions. And that starts with the interest rate swap market, especially at the short end, because the short end of the swap curve did for a time price the Trump trade. The 5-year swap spread maturity, that one was dropping sharply through the summertime along with everything else as the economy in the United States looked like it was heading for immediate trouble. And that didn't stop after September and October, even though the Federal Reserve shifted its position quite a bit. So the big drop in the swap spread, nothing good in that through November 4th. But then all of a sudden on November 5th, it turned around. And November 5th, we know what happened then. That was the presidential election. So the swap spread decompressed from a record low of minus 38.7 basis points on November 4th and got all the way to minus 30.2 basis points by the end of November, specifically November 27th. So that's a pretty big retracement in that short run swap spread, which means that the swap market was, at the very least, considering the prospects of the Trump election, what the new incoming administration might do for the overall shape of the economy. So there was some Trump trade, belated as it may have been, at the short end of the swap market. The 10-year swap spread, however, much less of an impact there. That one, like the 5-year maturity, was dropping like a stone, big-time negatives all the way through November 4th, too. It got to a record low of minus 52.9 basis points on November 4th, so nothing good from the 10-year either. Now, there was only a moderate backup and retracement in the 10-year spread. It got to minus 47 basis points by early November, so less than 5 basis points of retracement, much less of enthusiasm over the Trump trade at the longer dated maturity. And then you go out to the 30-year maturity. That one, again, record low, minus 86.2 basis points November 4th, had been screaming lower up until the election. Nothing good from the swap market at any of the maturities, including the long-dated one. And then less of a rebound after November 4th. So not much of a Trump trade necessarily in the longest dated swap, more of in the introduction of some positive volatility, even though the previous trend was mostly intact. So the entire swap curve from November 5th onward, over the couple weeks afterward, was at least considering the Trump trade and what the incoming administration might do more toward the short term rather than the long term, that maybe some new policies, anything different was considered to be a positive given how the economy evolved over the last several years. But it was mostly limited to the short run. At least the swap market view of it was maybe there would be some short run impacts, but when you go to the longer dated swap spreads, especially the 30-year maturity, it really wasn't pricing so much of a possibility of a long run shift in all of the negative potentials that have developed over 2024. It was really mostly in the short run, the 5-year and even the 2-year swap spread, where you see, at least for a little while, some consideration over the Trump trade. And other indications too, especially the longer term indications like the copper to gold ratio. You don't see any real deviation there either. In fact, the copper to gold ratio didn't actually hit its multi-year bottom until later in November. And so as of the end of 2024, the beginning of 2025, the copper to gold ratio is right back down where it was just a couple weeks ago. Essentially, there's not much of a Trump trade, any of the long run indications. So whatever positives that the Trump administration might bring to the short run, they were not shared, at least the optimism wasn't shared by the longer term indications in the swap market or copper to gold and other places as well. And even the short run swap spread, that one turned around at the end of November anyway. This is the date that we keep coming back to over and over again, at least this couple dates at the end of November, right around November 26th and 27th. We see that in the 5-year swap spread maturity, as I mentioned, but also in things like, dealer inventories of treasury bills that were building up the week of Thanksgiving, entering the first week of December that I talked about in a previous video. The T-bill auctions that followed immediately after that, December 5th in particular. You had that massive surge in bids for the 8-week auction. So we've got dealer inventories, 8-week auction of bills, the 4-week auction of bills after that. So potentially some collateral disruptions that developed the week of Thanksgiving into the first week in December. And all of that was ahead of the November payroll report, which introduces another angle, which is U.S. macroeconomic risk, because the payroll report, contrary to most mainstream assessments, was not a good one. Neither the headline nor the details, especially the rise in the unemployment rate and the drop in the household survey. So the end of November entering December, we see U.S. macroeconomic risk really come back as well. And then maybe the biggest one, November 27th, we see a real downturn, real acceleration to the downside in Chinese bond yields. Now, those were already going lower October into November after the failed bazooka, but they really accelerated to the downside after November 27th. So same as the 5-year swap spread maturity, as well as all the stuff going on in collateral in terms of treasury bills that I just mentioned. Plus, then you got the massive flight to safety at the front end of the Chinese government bond curve, the 1-year maturity, which absolutely plunged into December. So some really serious degree of financial chaos in the Chinese market that began around November 27th. And over the last week or so, the 1-year maturity has retraced some of its plunge in yield, but only a small amount, which means that the 1-year maturity is down big time during December. And even the 10-year maturity, which was just accelerating after November 27th, that finished up last year, 2024, at a record low below 1.7%. So something big happened in China's bond market from November 27 forward. And of course, that date, or those dates around the 27th, the 26th and 27th, also show up in the currency markets that we've been talking about a lot in December, especially Brazil as well as India. And there's a couple others, as I'll mention here in a second. There wasn't so much in China's yuan. The yuan was relatively stable and actually moved up a little bit November 29th, but then there was a pretty big drop from November 30th through December 3rd, which is, again, that same window that we keep seeing end of November into December, where the yuan went from 7.24 to the dollar down to 7.2850. And it has since continued lower to the point that somebody in China is intervening in the currency markets to keep the yuan rate, the onshore yuan rate at 7.30 to the dollar, actually just above 7.30 to the dollar. It's likely Chinese banks at the behest of central bank authorities borrowing in swaps markets and redistributing into the onshore marketplace. And they're also doing some things in the offshore market as well. So while there wasn't a huge reaction in the currency market for China's yuan, there definitely was for India's rupee. And it's right on November 26th. That was the peak, or at least the point before which the currency really collapsed. So on the 25th, the rupee was 84.27 and had been on a very slight short-run rise before then. Then starting the 26th, it just sinks. And it dropped to almost 86 to the US dollar as of more recently, which is a record low. And I've talked about what's going on in India, a massive surge in foreign debt. The Reserve Bank of India has expended an enormous amount of the country's reserves trying to defend the rupee and only making it worse. They've given up on their non-deliverable forwards, stupidity, a whole bunch of stuff going on in India that I've talked about repeatedly. Another one, Brazil. The real was absolutely crashing. When did that crash start? Yeah, November 26th and November 27th. It had been stable throughout the month of November, and then on the 26th, from a rate of 580 or really almost 581 to the US dollar, it just crashed down to 609 by December 6th. So there we go again. Final week in November, first week in December. It got so bad that on December 12th, the central bank there, Banco do Brasil, decided that they were going to hike rates by 100 basis points rather than 75 as the market expected, plus promising to do it twice more at each one of its next two meetings. So big intervention by Banco in interest rates. The government started to intervene directly in the spot market as well as auctioning off credit. So interventions in the FX markets from Brazilian authorities. The real itself got down to a low of 6.26 to the dollar, and since then has stabilized over the last half of December, but it's still incredibly weak and looking like it's going to move weaker once the interventions wear off as the year ended. So it's still around 6.20 to the US dollar. Another one, likely a related one, Korea's won. While South Korea has been gripped by political turmoil, the currency has been weaker, far predating what's happening in Seoul. In other words, the currency has been weak really going back to the summertime, because like a lot of things, summertime was not good for the world. Big inflection across the global economy, which is likely playing a big part here. But it really plunged after the end of September. So September 27th, there was a big plunge in the Korea's won. So again, nothing to do with the political situation. Then there was a pause in November, sort of like the rupee and the real, between November 12th and November 27th. But then again, after November 27th, you don't even really see the martial law or the failed martial law attempt on December 4th in the behavior and performance of the won. It just continued to move lower after November 27th. So the big question here is what happened on November 26th or November 27th in that window, the final few days of November and the first week in December? What was the trigger here? We've got a couple of suspects. I said before, collateral shortage, scarcity, treasury bills, that kind of thing. But also, like I said in the introduction, we have to consider the prospects of trade wars because it appears like the market is at least considering them in some limited capacity. On November 25th, President-elect Trump tweeted, well, he didn't tweet, he issued a statement on Truth Social that said, in no uncertain terms, he was going to implement tariffs on day one of administration. Here's what CNBC wrote up on the 26th. President-elect Donald Trump plans to raise tariffs by an additional 10% on all Chinese goods coming into the U.S., according to a post on his social media platform, Truth Social. The post immediately followed one in which Trump said his first of many executive orders on January 20th would impose tariffs of 25% on all products from Mexico and Canada. Such a move would end a regional free trade agreement. So it looks like, because that was the most significant, at least political development that happened at the end of November, and it seems to line up with the timing, it looks like there's a possibility the market said trade wars is going to be potentially one headwind too many. Because I keep repeating it in this video and every other one I've been doing, that there's been trouble in the marketplace and the economy all year, even before we get to the election and trade wars and Trump trades and everything else. So you've got currencies that are weakening, rates that are falling, central banks that are cutting long before we get to November. So the global economic and financial climate was not good heading into the end of November, into December. And then along comes the prospects of trade wars. And however you want to view trade wars or not, trade restrictions and policies, the market it appears to be looking at that and saying, yeah, this is potentially one more risk that we can't abide by. It's already bad, and this is just going to make it that much worse. And that's where the urgency in all of these markets has come from. But there's also, that's a possibility, but if that was indeed the case or the entire case, then we would also see something similar in Canada and Mexico, at the very least the loonie and the peso. But we don't. Now, both the peso and the Canadian currency, the Canadian dollar, have been weakening, but they didn't start weakening abruptly, nor did they shift on November 26th, 27th, or in that same window. In fact, they just continue to be weak throughout the last several months, and the peso going back further than that. So if it was just trade wars, why didn't we see an acceleration downward in the loonie or in the Mexican peso? And maybe just because they're already weak to begin with, and this was just confirmation of the reason for that weakness, or what we're really saying is there's likely a combination of factors here. So for the Brazilian real, for example, or Korea's won, along with all the stuff in China, it may be that the prospect of trade restrictions and the reduction in trade because of that is, as I said just a minute ago, it is that the market's saying it's just one more negative that these places cannot handle. They're already in bad shape to begin with, and this is just going to add one more that they can't handle. It's the straw that broke the camel's back. And it would make sense in China because China's in really bad shape, despite the latest non-manufacturing PMI, which I'll get to in an upcoming video. So China's already in bad shape. We know trade restrictions are not going to help the Chinese situation out any. And then anything upstream of China from there, including Brazil, which has already got its own massive problems as well, it makes sense that potentially trade wars would just be going too far with all of the negatives. So China and Brazil and Korea, which is, again, a complete mess there, especially considering the potential of the AI bubble to be reversing here. In Asia specifically, trade wars might be too much. And then as far as Korea and Mexico, like I said, their economies are experiencing their own difficulties to begin with. So this is just another one, another negative on top of a whole bunch of others. But what I keep coming back to is in the swap market. So you had the 5-year maturity sort of consider the Trump trade for a couple weeks there between the election and November 27th. Then the 5-year maturity turned around, which I don't necessarily believe that's about Trump trade or Trump trade wars. More so, I think that has to do with what the longer dated swaps were saying all along when not really doing all that much or reacting that much to the Trump trade or trade wars, either one. And longer dated swaps are moving in almost a straight line, which is unusual to begin with because nothing ever goes in a straight line. So the trend lower in longer dated swaps says that none of the short-term stuff actually matters. It doesn't matter the Trump election or the prospects of trade wars. One might be positive, one might be negative. Maybe none of them are positive and all of them are negative. Doesn't matter central bank rate cuts. Those don't factor at all. The swap market is reacting to longer term factors which don't appear to have changed no matter what has happened over the last few months of 2024. In other words, the swap market is saying it's all the downside of the supply shock anyway. And so I think that's what makes sense explaining all of these facts up to and including the prospect for trade wars. So from that perspective, the short-dated swaps, they give the Trump trade a shot and say, well, at the end of the day, it's not going to make much difference over the intermediate and longer term. So the Trump trade at the short end of the swap curve makes sense. Well, it doesn't make much difference at the long end, just a little bit of positive volatility that didn't last. The trend's still very much intact. Now, this is not a judgment by the markets on those policies or any ideas. It's just that things are so screwed up that there aren't going to be nearly enough, those policies or ideas are not going to be nearly enough to turn it around or turn it around quickly. It may just be that there were too many negatives all coming together in one place. And at the same time, that all the presumed positives, including the Trump trade, as well as stimulus from China and rate cuts from central banks, those were judged to be ineffective at best. So you put all of these together, the developments at the end of November across the world, across the marketplace, the baseline behind it all, and it led to a pretty chaotic November and the same thing happening at the start of 2025. Yeah, it might even be the stock market is caught up in all of this global shifting that happened last month. I talked about stocks in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And to all you new members and subscribers, huge thank you too. And until next time, take care.